Good morning. I'd like to introduce myself again. I'm Ben Breslau with JLL. I run research for JLL across the Americas, and it's an honor to be here. I want to extend my thanks and gratitude to our hosts as well. It's been an amazing experience being over here to see your country and meet some of you. I realized also as I was looking up here at the podium, I do presentations a lot with my job as sort of our economist. This is my first time speaking at a stock exchange, so I'm happy that that's here. Then I thought about the fact that I have a twin brother who actually works for NASDAQ, so I have to go tell him he's behind. Now he's got to get me a slot there. So my job is to talk a little bit over the next 20 minutes or so about the US economy and the markets of DC and Boston. You heard a little bit from Car Properties about DC, and we did not coordinate this ahead of time, but you'll see some of the same themes, which is nice. Smart people think alike, I guess. So one of the things I wanted to start with is I like to put the scary screen up first and then try to make everybody feel better as we go. This has been a very unsettling start to the year. So if you read the headlines, these are some of the macroeconomic headlines. There are many more. There are geopolitical headlines you could put up there. These are things that don't necessarily impact real estate, properties, occupancy, rents day to day, but they do impact how people feel. And certainly at the start to this year, there was an unsettling feeling in the headlines. My recommendation to people usually is turn off your phones, don't read the Wall Street Journal for a while, and just focus on your own business, and you'll probably feel much better. But in fact, there were a lot of things going on, external factors to the US economy that were causing people concern, and it led to a fairly significant, by the way, I'm not going to go into detail on all of those because I have 600 slides to get through in the next 20 minutes. Not quite that many, although I do have all those back at home if you want more detail. But what that did lead to is an unsettling feeling in the macro world, and specifically a shift away from risk in the financial market. So this is a trend over the last 10 years or so of financial conditions, how tight or loose financial credit conditions are, and it's based on currency and interest rates and the stock market and a bunch of other things, volatility. And so what you see is nothing compared to the financial crisis of 2008, 2009, where financial conditions tightened significantly in the crisis, but certainly the combination of the Fed rate hike, first rate hike in December, China, oil, there was a shift away from risk across the stock market. The S&P broad measure of stocks in the US dropped by something like 15% between January and the end of February, and that rippled into the real estate markets in terms of credit spreads widening on CMBS, in terms of investment sales slowing. I'll talk a little bit about some of that, in terms of some hesitancy from the tenant base as well. The thing is that stock markets and financial markets over the long term will find fair value and are good predictors of the real economy, but over the short term they swing wildly on investor sentiment. And what I kept telling people during that time when the stock market was way down was a quote that I love from a US economist in the 1960s, that is, the stock market accurately predicted 9 of the past 5 recessions, meaning it misses as many almost as it gets. And in fact, the correction we had earlier this year was the 3rd time during this expansion cycle that the stock market dropped by at least 10%. So when you flip to what does that mean for the real economy in the US, we like to look at some of the leading indicators and jobs data, and I'll show you just a little bit about that before we get into the real estate markets. This is a look about what's been happening over the past 18 months or so when this market's been unsettled in the economy. And if you see the red line, we've broken the market into manufacturing and non-manufacturing in the US. This is the ISM index, Institute of Supply Chain Management, and it's similar to a PMI index around the world. Typically below the line of 50 is contraction and above the line is expansion. And so manufacturing started to contract in late 2015, both because of the weakening global economy and also because of the strengthening of the dollar. That's what got all the headlines, and particularly in the political election cycle. The Chinese are stealing our jobs and our jobs are going to Mexico. We have to stop immigration. That gets all the headlines. The good news for us in the US is that segment, that red line, only counts for 12% of our economy. 88% of the economy is non-manufacturing. So that's services sector, finance, technology, healthcare, education, retail, tourism. That part kept expanding. It did have a little bit of a dip, but some of the leading indicators are now coming back up. So if you think about the dynamics of what's going on in the economy, actually in the fundamental US economy, things still look pretty good. And job growth is something we focus heavily on. And the job numbers, despite all the volatility and the recent GDP numbers that just came out for the first quarter in the US, was only 0.5% growth. So with the unsettling headlines, with the manufacturing jobs being lost, and with 0.5% growth, all the signals start going up and the headlines about recession is coming. Probability starts going up for recession. We didn't believe it all the way through because we kept focused on this stuff, which is what really drives people in seats of the properties that drive the office market. And so we've been clipping away at about 200,000 jobs per month. The last one was a little bit lower for a variety of reasons, but generally the job market has been pretty strong. Almost 2.7 million jobs over the last year, 2% growth in the office market, which tends to translate into net absorption, 2% growth in employment, which tends to translate into net absorption in the office market. And some of the leading indicators like job openings and people's willingness to change jobs also still point to fairly healthy job growth. Our prediction is that 2016 will continue to be a fairly good year for the US economy, and 2017 as well. 2018 and 2019, you could start getting into point where this cycle starts to get long. But I do think that this cycle, the end of this cycle, will be a volatile one probably because of some of those unsettling macro headlines. And so be ready for volatility, but we expect it to be a relatively positive future. So what does that mean for the real estate market? This is a visual that we use at JLL called the property clock. It's basically like the sine curve of a typical market cycle, but turned on itself. The right side of the clock, how to read it, tends to be falling markets that are favorable for tenants, where you have either a bad economy or oversupply in the market, and you have increasing vacancy rates, decreasing rents. The left side of the clock tends to be good for landlords and investors, where you have a strong economy, growing occupancy rates and tenancy, and decreasing vacancy and increasing rents. And once you get to about 9 o'clock on the clock, that's when rents typically get high enough to support new construction in the marketplace. So the overall view of this is that almost the entire US market is in a very healthy place from an investor's perspective. Office vacancy in the US is at a 7-year low as it's been in this cycle. And rents are rising almost across the board, although if you look, there's peaks and valleys in different places. The one exception, just to make a quick note, because I'll get into some of the specifics of DC and Boston, is Houston. With the drop in oil prices, you can see that fell over the cliff earlier this year. Significant supply pipeline coming, and also significant sublease space coming back to the market, and that's going to take a while to correct. In the top quadrant, the peaking phase, you see a lot of our high-tech markets that are starting to get a little bubbly and maybe slow down a bit. The Bay Area, San Francisco, Silicon Valley being examples of that. And then you see some of the other big gateway markets like New York and Boston and Chicago and DC following a bit behind because of the slow growth in the government sector, but all really strong on that sort of up phase of the market. If you look, that was the leasing side of the equation. If you look at the investment side of the equation, you see a similar ramp-up story to the economy, where from the sort of the depths of the downturn, we've had massive increases. What you're looking at here is commercial real estate investment volumes across property types. We showed you not just office, but just to show you that across the whole spectrum, the world is investing in U.S. real estate, and has been growing by 20-25% year over year. It's hard to see in this a little bit, but we made a prediction for this year that we're going to have flat, and actually I think it may end up coming a little bit even below that. And the reason is because the first quarter of this year started fairly slow from an investment perspective. And it may have even been slower if some deals didn't come from the fourth quarter and flow into the first quarter of this year. That was from the hesitation on both sides, buyers and sellers, the concern about the macro environment and the potential for a recession and maybe to get better prices. As we worked through some of that and the economy got on a bit better footing through the volatility, I think you're starting to see that marketplace open up a bit, and transaction volumes will come back into the market. Interestingly, the industrial market and the retail market were down by the biggest percentage, where multifamily, our for-rent residential market, and office were flat to a little bit positive nationally. And part of the reason for that is the U.S. is still the largest most liquid and safest real estate investment market in the world is underallocated to our real estate in general, and there's a wall of capital looking for yield. And this is a place where you can still get yield. A lot of people look at the cap rates, and I'll talk a little bit about where cap rates are in the two markets, Boston and Washington, D.C. But one of the things that people forget about sometimes when they think about the fact that cap rates are down to or past their previous lows is that the spread is still very healthy because, as was mentioned before, the cost of capital is much lower than it was. There is some concern about what happens when interest rates go up, and actually yesterday, some of the Federal Reserve presidents of the different branches of the Federal Reserve talked a little bit about the potential for interest rate hikes. The Fed has a standoff right now with the bond market where the Fed is trying to signal that they're going to raise interest rates a bit to show confidence, and the market is saying we don't think so, we don't believe it. But either way, actually in a rising interest rate environment, real estate, private commercial real estate tends to actually do very well because it tends to show that the economy is strengthening, and that offsets some of the impacts of the real estate, of the interest rate rises. So that was all about the economic cycle, which I spend a lot of time talking about. One of the things before I get into Boston and DC that I just wanted to mention is we spend a lot of time also focused on cycles that have nothing to do with the economy, but are critically important to effective real estate investments and performance. I'm actually not going to go into politics today, but I like to see people's reaction when I put my friend Mr. Trump up on the screen there. And certainly for a marketplace like Washington, D.C., and I'll talk a little bit in a minute about the political cycle is an important factor, not the only factor, and it's diversifying from that nicely, but it is an important factor. And then you have on the other side of the equation things like the innovation cycle, where we're calling it the fourth industrial revolution, where you have mobility and automation and connectivity, the Internet of Things, and the Uberization of our society in a lot of ways, truly impacting what the customers of real estate are doing, what their employees are doing, how people think about their work, their workplace, where they want to live. And then you also have this wave of demographics in the US, and particularly a little group called the millennials, which is about 80 million people that currently range from about 15 years old to 35 years old. And they are driving change in our marketplace in a lot of ways. They grew up with iPhones in their hands. They have been connected with their friends. They take Uber to work and to school with no problem. They love to live near transit. They're driving a certain new kind of workplace experience that's all around collaboration and innovation, and it's changing design and underwriting for real estate investments, and Ollie talked a bit about that. And what we're finding is some of those things are not just millennial, right? There's even older people like to have a roof deck and have a nice, cool coffee shop in the lobby, and some of the things that the millennials are driving. So we spend a lot of time focused on these, and you'll see these three themes ripple through some discussion about Boston and Washington, D.C. Okay, so let's talk about the D.C. story. And as I said, I'm happy that some of the things you heard from Ollie and John, you'll hear again from me, which will save me some time so I can get through the other 600 of my slides. Washington, D.C., just quickly, is one of the true global gateway markets, one of the political capitals of the world, our national capital, but also is one of the most educated. It's interesting to talk about D.C. and Boston because they both claim, and I've spent a lot of time in both, to be the most educated. And the truth is they are each the most educated, depending upon which statistics you look at. That's one of the fun things about being the research guy and the economist, is that I could prove both of those cities are right. And the good thing for Alani Hetz is you're looking at both of them. So you have two of the most educated markets in the US, certainly. But DC clearly has is a large market. I think most people don't realize, as Ollie mentioned before, that it's the second largest downtown market with over 100 million square feet of office space. And it's got infrastructure, it's got actually population growth, especially in the city coming in from the demographics, and it's got the US government, which I'll talk about a little bit more. This is a little bit hard to read, and I won't go through the details, but just to give you a little bit of the commercial geography of and I'm going to focus on the real estate market, really on the core, not on the outer areas. That's where the focus has been for the investments. You've got the CBD and East End, which comprise the lion's share of the sort of institutional stock, and you've got kind of, generally 10 to 15% vacancy rates, and rents in the, kind of 60, low to mid 60s gross, full service in general, although you also have rental rates that go up to the mid 80s, sort of on the high side and the more trophy set. And then you've got a collection of submarkets around it as well. The biggest tenant in DC, and one of the biggest tenants in the country, is the government. By our calculation, there's about 50 million square feet of leased properties by the government. This doesn't include all the contractors, all the government, the government affairs offices, all the ancillary benefit of having the government. This is just the government. And the difference between the 15% of this is Metro, by the way, of the leased market, and the 25% is owned property and also some agencies that they don't want you to know that they're the government, but we estimate that they are the government. So although the government has had slow growth, and this has been a little bit of the reason that the DC market has been slow out of this recovery, it's nice to have probably the world's preeminent credit tenant as your anchor for your market. As they said, that this tenant is unlikely to relocate anytime soon, and they tend to lease properties for a long period of time. So I think the average leasing in the past has been something like 25 years. It's shrinking probably a little bit as they get more nimble and try to get more nimble, but this anchor with a little bit of new growth around it has been really exciting for DC. Someone asked me earlier when we were talking about whether it's better for a Republican to be for the office market, not for the political views in general, but Republican or Democrat, this candidate or that candidate. This is a correlation that we've been studying between the amount of legislation passed in the DC market and the net absorption in that market. And what we found through our analysis is it actually has very little to do with whether it's Republican or Democrat. What is most important is that there's alignment in party control between the White House, the presidency, and the Congress. So that's how they get things done. So when there's Republican and Republican, they get a lot of bills passed. When there's Democrat and Democrat, they get a lot of bills passed. They may be on different things, but they get a lot done, and that tends to be good for activity in the marketplace, for the growth of agencies, for the growth of the big law firm presence in the marketplace, and some of the ancillary contractors that are there. So what's made the market slower recently, stable but slower, is that we've had gridlock in our government, as is widely documented, and between the Democratic presidency and the Republicans in the House, and that's made it very hard to get anything done. It's not just the government, as Ollie mentioned before. This is a headquarters market for contractors and hotels and other companies, and that diversifies the marketplace a bit. And in addition, the new energy that's coming into DC and a lot of other markets, the big urban markets around the country, is the tech sector. So if you look at where growth has been, this is job growth across the traditional sectors, the government, finance and legal, and the tech sector in DC over the past year, and you can see that the growth has all been tech. And what we talk about a lot is the fact that tech used to be a very niche sector. Now every industry is tech, so some of them are working on cybersecurity, some of them are working on robotics and manufacturing, some of them are working on all sorts of different industries, healthcare. But these companies are favoring cool, creative, innovative kind of spaces, and I'll touch again on that in a second. Ollie made the point before about the shift in the core kind of institutional part of the market by tenants to newer quality spaces because they're more efficient, because they've got better design, because they've got better amenities, because they're designed with today's customer in mind. So this is a slide that we put together, again, not knowing Ollie was going to make that point. I'm here to help prove it for him, that properties that were built more recently since 2007 with this sort of new design, with this new character, have a much lower vacancy rate than properties built before 2007, which are not that old. But properties that are 80s and 90s vintage are finding it very hard to release when they get vacancy. The second generation spaces take a lot of capital to put in them to reposition them to the new way of occupying space. And therein lies a challenge for that midsection of the market, the kind of middle A space that's not differentiating itself, but also a great opportunity for those investors who know how to reposition it. The tech tenants and the creative tenants and the sort of startup community that's evolving in DC, some of them are in the core, but they're also following the metro lines, the subway out into all sorts of new creative places and putting new dots on the map with not only their own spaces but co-working spaces as well that are activating different parts of the city. To reiterate that point about how important metro is, this is an analysis that we've done about the share of leasing activity within a half mile of the train stations, the subway stations. And so over a long period of time, it was in the mid-60s, and more recently, it's jumped up to over 90% of leasing activity is tenant driving demand to transit. As I mentioned before, sales volume has dropped a bit because of some caution in the marketplace, creating a potential opportunity, but also some hesitancy for sellers to sell into this market. You still see fairly aggressive cap rates that have been trending down a bit, and the real trophy part of the market, it's probably more between 4 and 5 than 5 and above. But a little bit slower activity so far this year in the DC marketplace. So I'll wrap up DC and then spend just a few minutes on Boston to close this out with saying we're actually kind of cautiously optimistic about the fundamental trends in DC, the diversification from the stable anchor in the government with some new energy coming to town, the bones of the city in terms of infrastructure and location and education and demographics are very strong. And we think that's, although sales volume is taking a little bit of a hit this year, which might make opportunities more difficult, we actually think we'll see some good steady growth going forward for DC. So now I'll give you the Boston story briefly. Boston is my hometown. Those are all my boats in the front. To understand Boston is a little bit different. We're a big sports town, okay? So I spend a lot of time in Washington, D.C. and a lot of time in Boston. When you go to, one of the ways, this is the analytical part of me, one of the things I like to do is I go out and see what people are doing to understand what makes sense in the city. So I go to the bars, just for research, not for anything else. And in D.C., if you go to a bar, you will look up at the TV screens behind the bar. It will all be the political talk shows, all the time. Some of them Fox, some of them MSNBC, all the way around. If you go to Boston, it's all sports. It's Boston Red Sox, the Celtics, the Patriots. So that's sort of what we debate over a cold beer. We're also obviously the educational hub. I'm going to talk a little bit more about that. Nathan mentioned that as well. And also to survive Boston, and some of our friends from Alani Hetz learned this the hard way the first time they came. I'm very proud of them for surviving through this. You have to be okay with snow because sometimes our city gets buried in snow, and you need special equipment for that. The Boston marketplace is really a story about the DC is all about the government and the stability of the government. Boston is all about the mind and the intellectual capital that's there. Again, lots of statistics that sort of show that I won't go into, but high tech, life sciences, education, healthcare, very strong in Boston. This is a little bit of a look at our commercial geography in Boston. A little bit different in that Boston is a peninsula. The hub of Boston is in the red, that's downtown. An interesting thing about downtown is for a long time, since I've been in this business almost 20 years, that red spot was called the financial district. Now we call it downtown. Why? Because tech tenants are coming back into the cool part of the town. They don't want to go to the financial district. So we changed the name. Now they come in and they come downtown. Where are they coming from? They're coming from East Cambridge. So this is about a 65 million square foot chunk of submarkets. The hub is downtown and the Back Bay, which is sort of our 24/7 active mixed-use neighborhood. But both Harvard and MIT, two of the most renowned educational institutions in the world, are both located in East Cambridge in sort of the light blue across the Charles River. And they are 1.5 miles from each other if you walk it. And the amount of intellect, the professors, the research, the commercialization, the startup economy that spreads out of those and populates the rest of Boston is truly amazing. And the problem is Cambridge gets full very quickly. So you see the vacancy rate there is under 4%. Rents are the highest in this whole marketplace in East Cambridge near MIT. So the tech companies start to spill out. They go to the Innovation District, the Seaport, then they come back into downtown and they start to make downtown look cool like Cambridge. The stability of DC is all about medical, all about the government. Our anchor tenants are we call them the meds and the eds, the hospitals and the universities. We're fairly certain, last time I checked, that places like Harvard and MIT also are unlikely to relocate. So you have this very stable base around what can be a more volatile, cyclical kind of tech and biotech kind of environment. Was mentioned before that Boston is all about the talent. We have a third of our population in that young working age, 20 to 34. We graduate 150,000 students every year. A lot of them stay and start companies and grow and do very exciting things. So you have this sort of, we call it the perfect storm in Boston, where you have some infrastructure as well, where we spent $20 billion to put the highways underground and to build parks and to reconnect the city with the waterfront. You have the knowledge and education economy, which is not only the startups, but now you have big blue chip companies like GE that are moving their headquarters. This one is moving its headquarters from Connecticut and Fairfield to Boston because they want to reinvent. They want to be a innovation company. They don't want to be the manufacturer. They still do trains and jet engines and all that sort of stuff, but they want to attract that kind of talent, so they move to Boston. That'll be a halo effect around that. For a long time, we were losing headquarters in Boston because it was too expensive. Now we're gaining some of them back because they want to tap into that capital. And then, of course, the demographics that I mentioned. So just a little bit of a historical rent trend that's interesting here to think about the dynamics of the market. Boston is still below its previous peak, which is part of why we feel like there's still some room to run in terms of rents in Boston in this cycle. Cambridge, which tends to get very hot when the tech market gets hot, has the highest rents in the neighborhood, a good 20%, probably at the top above, 10 to 20% above Boston rents. And because of the low vacancy, that's why you're starting to get companies that spill out into Boston. The other interesting thing about this recovery in Boston, to give you a little bit of detail, is that typically in a recovery, the core market, the best buildings recover first, and they recover sort of from the top down. The best view space goes first, and the full floors, and then as you go, you fill in the pieces as the recovery gets bigger and there's less options. This one has happened a little bit the other way, where the creative tech kind of companies are the ones that are driving growth, and they're growing from the bottom up and from the outside in. So from Cambridge and Seaport into downtown, and from the cooler spaces that are closer to the coffee shop on the bottom floor, and then the slower market has actually been a little bit more of the full floor, higher up spaces. So you see the rent growth kind of going from the bottom up. This is just a sense of the investment market in Boston, and one of the reasons why it's very hard to penetrate the Boston market is because all of these X's show properties, institutional quality, high-end office properties that have sold within the last 3 years. And the red ones are the ones that have not sold. And most of the ones that have sold have gone into very long-term, stable ownership hands, so they're maybe less likely to trade again in the near future. And so this makes it a very difficult market to get into. There's obvious reasons why people want to get in, and it makes position in Boston all that much more powerful. The returns, the expected returns in Boston, again, the high end of the market is trading in that 4 to 5 or 5.5% cap rate range, and there's aggressive underwriting in terms of rents still. The rental rate growth in Boston has been pretty extraordinary, 30% over the last 5 or 6 years, and we expect that that'll slow down a little bit, but still could have a good sort of 3 to 5% growth over the next couple of years. So to conclude, again, fairly healthy marketplace, a little bit of a pause in the beginning of this year, as has happened in other markets, but tenant demand is still fairly strong. We feel good about the underlying economic strength of the market, and relatively limited development pipeline in Boston that we expect to maintain Boston as one of the stronger markets in the country. And with that, I will conclude and say thank you very much.